Welcome to the lesson, candidates. The subject is Advanced Auditing and Assurance. We are answering questions that were tested in August 2024. We've so far done question 1 up to question 3. Today we are moving to question number 4. Part 4A reads, Auditor independence is part of the foundation of the auditing profession. An independent, reliable, and ethically sound audit gives a company credibility and allows the public to trust in the accuracy of the results and the integrity of the accounting profession. With reference to the Institute of Certified Public Accountants of Kenya ethical guidelines, justify 5 reasons why professional independence is considered important to the auditor. With reference to the Institute of Certified Public Accountants of Kenya ethical guidelines, justify 5 reasons why professional independence is considered important to the auditor. Importance. Reasons for the importance. That's a question. August 2024, question 4. A. Reasons for the importance of the auditor's independence. Now, the auditor is required to be independent, meaning that he should not be influenced by anyone. He should be free from any undue influence from the management, from any source. He's supposed to be objective, independent, make decisions without any influence. So what do you think, candidates? So what do you think? What are the reasons for the importance of auditors' independence? Auditors' independence. Auditors' independence, candidates have said, is a freedom and the objectivity of an auditor to carry out their work without any undue influence or conflicts of interest. It means that the auditor can make impartial judgments and decisions without being swayed by personal, professional, or financial considerations. The question is, what are the reasons for the importance of the auditor's independence? The auditor is required to be free to carry out his work without undue influence, without conflicts of interest. He should be impartial and should not be swayed by financial considerations, professional or personal considerations. The auditor should ensure that he has no blood relations with the management team, because that can compromise his independence. The auditor should ensure that he has no financial interest in the company that he is auditing, because again that can influence his judgment, that can make him that can influence the way he makes decisions. So he should ensure that he does not find himself in a situation where he is not impartial. Any considerations, anything that will hinder his objectivity and independence, he is supposed to ensure that he is free from such. So what do you think that is important? And if you read the root, candidates, the root says, or the question, auditor independence is part of the foundation of the auditing profession. An independent, reliable, and ethically sound audit gives a company credibility and allows the public to trust the accuracy of the results and the integrity of the accounting information. So see, right there, candidates, you can get a point. Public trust and confidence. An independent auditor provides assurance that the financial statements are reliable and free from material misstatements. And that enhances public trust in the financial statements or financial reporting process and the capital markets. So one reason for the importance of the auditor's independence is in relation to public trust. When the auditor is independent, that boosts the trust of the public. That boosts the confidence of the public in the reliability and even credibility of the financial statements or financial reporting process. It enhances public trust. When the public know that the auditor is impartial, the auditor does not have financial interest in the company, the auditor is free to do his work, that boosts public confidence and trust. Now, looking at the route again, candidates, we are reading here things like an independent, reliable, and ethically sound audit gives a company credibility and allows the public of the blah 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 blah. So another reason for the importance of the auditor's independence is in relation to objectivity. Objectivity and impartiality. There's no way an auditor can be impartial without being, first of all, independent. Independence allows auditors to maintain objectivity and impartiality in their judgment so that they can assess financial information without bias or without undue influence from the client. Do you understand? Impartial. Impartiality. The auditor can only be impartial if he's independent. So that's one reason for the auditor's independence, because in examining financial statements, the auditor is required to be objective. The auditor should be objective. The auditor should maintain objectivity. The auditor should make judgment without any bias. That can only happen if the auditor is independent. 3, independence is also important due to what we call professional skepticism. Because being skeptical from the auditing point of view means having a questioning mind. An independent mindset candidate fosters a questioning attitude which enables auditors to critically evaluate evidence and identify potential risks and errors. We know that the auditor should not believe all the information that is provided by the client. The auditor should seek to gather corroborative evidence. And that can only happen if he is independent. But when the auditor's independence is threatened, then the auditor may not maintain professional skepticism. The auditor may not have an independent mind because he will be in a position that will hinder such or threaten his independence. So another reason for the importance of the auditor's independence is professional skepticism, fostering a questioning mind. The auditor can only maintain a questioning mind if he is independent. 4, unbiased decision making. Unbiased decision making is the reason for the importance of the auditor's independence. Independence ensures that the auditors can make unbiased decisions without fear of repercussions or without any pressure from the client. Five is also another reason is to maintain what we call professional reputation. Maintaining professional reputation. To maintain professional reputation. You can see here we've read that an auditor's independence is part of the foundation of the auditing profession. You see that? Auditor independence is part of the foundation of the auditing profession, because independent auditors are required to uphold the integrity of the accounting profession by avoiding conflicts of interest and also adhering to ethical standards, and that contributes to the overall reputation of the profession. So these are 5 reasons for the importance of the auditor's independence. 1, public trust. 2, objectivity and impartiality. 3, professional skepticism. 4, unbiased decision making. 5, maintaining professional reputation. Have you understood? An independent, reliable, and ethically sound auditor gives a company credibility and allows the public to trust in the accuracy of the resource and the integrity of the accounting profession. So part of the ISPAC ethical guidelines is the auditor's independence. The ISPAC guidelines require the auditor to maintain independence, to be independent, The auditor is required by ethical standards to be independent, to be free, and to have objectivity in carrying out work without any undue influence or conflicts of interest. Auditors are also required to make impartial judgments and also make decisions without being swayed by personal, professional, or financial considerations. So that is part A of question 4. Part B reads, you are a senior auditor in the audit of Jasiri Limited, a medium-sized manufacturing company. The audit of the financial statements for the year ended 30th June 2024 is almost complete, and you are reviewing the audit files for the period. The following issues have prompted the senior auditor to call for a meeting with the client's top management to be held in a week's time. Now, currently, you see there is a problem with the structuring of the question, because you see in the first sentence you are reading from the question that you are a senior auditor. Then in the third sentence you are reading that the following issues have prompted the senior auditor. The question should have read that you have called a meeting. So when the question continues, then the focus is on this senior auditor. So the question cannot now read the following issues have prompted the senior auditor, because the question here is addressing the candidate. The one who is sitting the exam he should put his shoes in the legs in the shoes, or he should put himself in the shoes of the senior auditor. So the question would have read, you are a senior auditor in the audit of Jasiri Limited, a medium-sized manufacturing company. The audit of the financial statements for the year ended 30th June 2024 is almost complete, and you are reviewing the audit files. You are reviewing the audit files for the period. You have called a meeting with the client's top management to be held in a week's time. The following issues have prompted the senior auditor. Okay, so you have called a meeting with the clients. The following issues are: number one, there were questions concerning the accuracy of the depreciation charged in the financial statements, and a preliminary investigation revealed that the computerized accounting system had failed to compute depreciation of equipment correctly, resulting to an overstatement of the depreciation value of 780,975. The book value of the equipment had been overstated by 1,128,340 shillings. The equipment value for the year ended 30th June 2024 was 7,135,725. So that's the first issue. The second issue, at the beginning of the year 2024, the company had issued a loan to Sarah Hagoi, one of the members of the top management, amounting to $500,000. On further examination of the records, it was discovered that the loan had not been disclosed in the financial statements because it was considered immaterial. 3. During the year ended 30th June 2024, the company made a reduction on its provision for customer warranties recognized in the financial statements. During the past 2 years, the provision has been made at the rate of 10% of sales for 3 months. The management has, however, decided to reduce it to 5% on the claims that the quality assurance processes had improved, and therefore customer warranty claims were likely to reduce. Further investigations, however, revealed that warranty claims have by far remained the same as in the previous periods. So these are 3 matters required. Discuss how the auditor would be expected to treat each scenario mentioned above for the purpose of reporting. The question should have read: discuss how you would be, or discuss how you would treat. You should have read: discuss how you would treat each scenario mentioned above for the purpose of reporting. Discuss how. You, and you here is the senior auditor. You are the senior auditor. As the senior auditor, discuss how you would treat each scenario mentioned above for the purpose of reporting. Number 2, propose how you would treat each scenario mentioned above in the auditor's report, assuming the management of the Limited does not correct the misstatements. 6 marks. So there are 3 issues. There are 3 issues. KASNEB Limited is experiencing, no, that is a different issue. The first issue, there were questions. First of all, candidates, you can see that we read that the audit of the financial statements for the year ended is almost complete. So the report is yet to be finalized. So the audit is almost complete. So when the report is almost complete, you see the supervisor, the audit supervisor has done his work, and so is the report. The working papers now are on the desk of the senior auditor. And as a senior auditor, you are reviewing the audit files for the period. And there are issues that have come to attention as you are reviewing the audit files. So these issues have prompted you to call for a meeting with the client's top management. And you can see one of the issues. Number 1, there were questions concerning the accuracy of the depreciation charge in the financial statements. depreciation charged in the financial statement. There were issues, there were questions, and a preliminary investigation revealed that this is investigation maybe carried out by the audit staff, revealed that the computerized accounting system had failed to compute the depreciation of equipment correctly, resulting to an overstatement of the depreciation value. So the depreciation value is overstated by 780,975. The book value of the equipment had been overstated by 1,128,340. So you can see there, candidates, that the depreciation charge is overstated, the book value is as well overstated. The equipment value for the year ended 30th was 7 million. So this is a problem, and the question now is, discuss how the senior auditor, you as the senior auditor, would treat this scenario for the purpose of reporting. So that is the question. How would you treat this matter? And you recall the stage at which the audit is at the stage of just reviewing the audit files. Because candidates, we know that the overstatement of depreciation and the resulting overstatement of the net book value of the equipment could impact the financial statement's accuracy. That will affect the accuracy of the financial statements, obviously, because depreciation directly affects both the profit and the net asset value. B. We're answering part B. Part B, Roman 1. The auditor, obviously, candidate should assess the accuracy. The auditor has to assess the accuracy of the depreciation figures to ensure that the financial statements reflect the true and fair view of the asset value. So the first thing the auditor can do here is to identify the misstatement. Identify the misstatement. Identify the misstatement. The auditor should first of all identify the misstatement. Clearly identify the overstated depreciation and the overstated book value of the equipment. Identify it. Then, after identify, the auditor should assess the materiality of the misstatement, because the depreciation charge is overstated, the net book value of the equipment is overstated. So after identify the misstatement, the auditor should assess the materiality of the misstatement. The auditor should determine whether the misstatement is material to the financial statements. And the auditor ought to consider both the qualitative and quantitative factors. is the misstatement material or is it immaterial? After assessing the materiality of the misstatement, then the auditor obviously should consider the impact on the financial statements. Consider the impact of the misstatement on the financial statements. Because as I said, this misstatement of depreciation charge and the misstatement of the net book value of the equipment affects both the profit and loss account and the balance sheet. So the auditor, after assessing the materiality of the misstatement, should consider the impact of the materiality in the financial statements. That is, if it's material, then what is the impact of this of this misstatement on the financial statements? Consider the impact. Evaluate the impact on the income statement, because an expense is overstated, and the impact of the overstatement of the net book value of the asset on the balance sheet. Another step, another thing to do is to discuss with the management, just as the question has suggested. Discuss with the management and request appropriate adjustment. Discuss with management and request appropriate adjustment. Because you recall, candidates, the audit report has not been issued. The audit is being finalized. So this one matter has come to the attention of the senior auditor. So before the auditor makes any opinion on the matter or the problem, because obviously it's a problem, is it not? So the auditor should, after meeting, because here we are you are seeing that we read that the following issues have prompted the senior auditor to call for a meeting with the client's top management to be held in a week's time. So within this week's time, the auditor should identify the misstatement, assess the materiality, consider the impact on the financial statements. Then the auditor, as he meets the management, should discuss this problem with the management and request for appropriate adjustment of the problem on the overstatement of the depreciation charge and the overstatement of the net book value of the equipment. Then Roman 2, Part 2, the second issue, reads, at the beginning of the year 2024, the company had issued a loan to Sarah Hagoi, one of the members of the top management, amounting to 500,000 shillings. On further examination of the records, it was discovered that the loan had not been disclosed in the financial statements because it was considered immaterial. So what do you think, candidates? And by now you should be ringing in your head is related party. the loan has been given to one of the members of the top management. A member of top management is a related party. Money is being given to a top management member, that is a related party. So that is what the examiner expects you to first of all acknowledge. So the auditor has to consider the implications of the undisclosed loan to Sarah Hagoi, who is a top management member. And we know the provisions, candidates of International Accounting Standards, is it number 24? Related party disclosures. The standard, that is IAS 24, related party disclosures, requires loans to key management to be disclosed in the financial statements, regardless of materiality. But here, because you see, we read that on further examination of the records, it was discovered that the loan had not been disclosed in the financial statements because it was considered immaterial, small money. So that's why it is not disclosed. But what does the standard state? According to IAS 24, loans to the top management, loans to key management members require disclosure in the financial statements, regardless of materiality, because they reflect potential conflicts of interest and affect the user's perception of the management's accountability. But that's just an observation, candidates. The question is, how would you treat that scenario? This is the second scenario. This is an undisclosed loan. Undisclosed loan to a member of the management team. So number one, assess materiality. Why candidates? Because we read from this question that on further examination of the records, it was discovered that the loan had not been disclosed in the financial statements because it was considered material. That is what the management stated. But you see, professional skepticism requires that you do not take such information as gospel truth. You are supposed to have a questioning mind. Any information that you get from the client, you have to question it. You have to approach it with an element of healthy doubt. You have to doubt it. That's why, as much as on investigation we are told that the loan was considered immaterial, you are safe to assess materiality. Determine whether the loan is material to the financial statements, considering both quantitative and qualitative factors. That's the first thing to do. Number two, consider related party disclosures. Consider related party disclosures. Consider related party disclosures. That is to mean, evaluate if the loan meets the definition of related party transactions and if adequate disclosures are required. then of course you may discuss the non-disclosure with management and request appropriate adjustments. Request appropriate adjustment. All right. Request appropriate adjustment. You see how easy these questions are? There are many ways, there are many points, there are many ways you can put across the way you would treat it. But you see, the assumption also could have been that the loan was approved. You see, the issue at hand is the disclosure, the non-disclosure. Because related party transactions are not prohibited. What is required is disclosure. Do you get the point? So the loan was given, but it was not disclosed. On further investigation, we are told that the loan was not disclosed because it was considered immaterial. But we know, according to the standard IAS 2024, the disclosure is required regardless of the materiality. So that is the second problem. Now the third problem, during the year ended 30th June 2024, the company made a reduction on its provision for customer warranties recognized in the financial statements. During the past 2 years, the provision has been made at the rate of 10% of sales for 3 months. During the past 2 years. The management has, however, decided to reduce it to 5%. Do you see that? It has gone down from 10% to 5% on the claims that the quality assurance processes had improved and therefore customer warranty claims were likely to reduce. Further investigations, however, revealed that warranty claims have by far remained the same as in the previous periods. Now, first of all, candidates, what is a warranty provision? The company made a reduction in provision for customer warranties. Now here you need to understand, candidates, that a warranty provision is just an accounting entry that sets aside funds to cover potential costs associated with the product warranties. Because when a company sells a product with a warranty, it is essentially promising to repair or even replace the product if it fails within a specific time frame. Do you see that? And we've seen, not some of you have bought items from, say, the supermarket. You buy electronics from the supermarket, like the iron, there is the electronic devices, refrigerators, they come with warranties, 1 year, 2 years. That means if the customer is unable to use that product within a given time because of failure, or the product requires repairs, then that means that the supermarket or the company is promising through this warranty to repair it or to replace it. You understand? So to account for the future expense, because the company is promising in future to replace or to repair, so the company has to set aside some money through the provision for the warranty. The company creates a warranty provision. You understand? So during the year ended 30th June 2024, the company made a reduction. So it's reducing the provision. Okay? During the past 2 years, the provision has been made at 10%. Now it is reducing from 10 to 5. And the reason is the company is arguing that quality assurance processes had improved, and therefore customer warranty claims were likely to reduce because they have improved on the quality. But you see, further investigations reveal that the warranty claims have by far remained the same. That's the problem. That is the problem. So a warranty provision is just a provision, kind of maybe like the provision depreciation. When a company creates a provision for depreciation, a company sets aside money every year. Okay, as the asset wears out, puts aside money until the end of the economic life of the asset, when the money that is set aside is now used to replace that asset. You understand? But that's the idea. So, and that is a problem. We've seen the problem. So the question now is, how would you treat this scenario, this problem? Can I hear from me? Reduction in warranty provision. Roman 3. Reduction in warranty provision. And you see, kind is reduced from 10 to 5. Understatement of liabilities, because you see that provision is a liability. So if the company is halving, it's reducing by half, from 10% to 5%, that means that the company is understating the its liabilities in relation to these warranties by half. It will lead to understatement of liabilities. And that is dangerous, candidates. So, what is the first thing to do? Assess the reasonableness of the provision. The auditor should assess the reasonableness of the provision. Should assess the reasonableness of the provision. The auditor should evaluate whether the management's rationale for reducing the provision is supported by evidence and sound judgment. The auditor may also consider the impact on future periods. Consider the impact on future periods. Consider the impact of this reduction on future periods. The auditor should assess the potential impact of the reduced provision on future periods, especially if actual warranty claims remain high. And here, candidates, the actual, according to the information we read from the question, actual claims will remain high. It's not that what we read is likely to remain high. Why? The management has, however, decided to reduce to 5% on claims that the quality assurance processes had improved, and therefore warranty claims were likely to reduce. Further investigation, however, revealed that warranty claims have by far remained the same. You see, the warranty claims have remained the same, yet the provision has reduced. So the company has not set aside money to meet these claims where customers are maybe returning the products. The company has not set aside money, and we see that is a risk, poses a risk to the organization. The company may not be able to meet its liabilities as and when they fall due. You understand? So the auditor has to consider the impact of this reduction in warranty provision on future periods. Then the third action is to discuss the concerns with management and request a review of the provision. Request a review of the provision from management. So the management may review it, may not review it. Because the adjustment should be to make it more appropriate. More appropriate means that reduction should be done away with. It should still be 10% because that has been the case before the reduction. Review of the provision, potentially adjusting it to a more appropriate level. So you see, candidates have just been giving 3 points because I'm guided by the question. When you are faced with this question, candidates, you try and see how marks are allocated. You can see, discuss how the auditor would be expected to treat each scenario. 9 marks. That means that each scenario you should give at least 3 points. At least 3 points. And we've seen, candidates, the last point is constant. That one has to happen. You have to have a discussion with management, because this is the senior auditor. The senior auditor, candidates, the role of the senior auditor, the auditor was not involved in the day-to-day audit of the work. He was not involved. The auditor was not involved. The senior auditor. The senior auditor here is reviewing the audit files for the period. The audit files have been brought to his table. So the audit of the financial statements is almost complete. When the audit is almost complete, the senior auditor has to review the audit files before the report, the opinion is expressed in the final report. The senior auditor has to review the audit files. So he has reviewed the audit files and he's come across these issues. All right. So I'm saying, look at them. For those of you who are going to do exams, please be guided by how the marks are allocated. Then let's look at the second part of the question, which reads, propose how you would treat each scenario mentioned above in the auditor's report, assuming the management of Jasiri Limited does not correct the misstatements. Because you see, in each scenario, the second part gives a hint on what should be the answers in the first part of the question. Because at first part of the question, the matters are to just be referred to the management, because the problems are brought about by the management. Okay, the top management. So the buck stops with the top management before the auditor expresses his opinion. So assuming the management does not correct the misstatements, because these are misstatements, the question now is, propose how you would treat each scenario mentioned in the auditor's report. Let's go back to the first scenario. The first scenario, this was the problem of the depreciation charge. It's part 2 of the question. Second part of the question, we have the overstatement. So the overstatement of depreciation charge and the net book value of the equipment. These two are overstated. Depreciation charge, that's depreciation for the year, and the net book value of the equipment. Now assuming, just as we had discussed in part 1 of the question, that the auditor should discuss with management and request for appropriate adjustment. So the management is required to make an adjustment to the depreciation charge and the net book value. Now, assuming that the management refuses to make the adjustment, what should the auditor do? That's the question. Issue except for qualified opinion. What is the rationale? Why would you do so? Due to non-disclosure. Because IAS 2024 requires that such a transaction be disclosed. So the report will be qualified due to the non-disclosure of related party transaction. To non-disclosure of related party transaction. The law requires that the management should disclose. the senior auditor has had a discussion with management and requested the management to disclose it. The management have refused to disclose it. So when writing the report, the auditor should qualify it, except for. Because the omission affects the integrity of financial statements. As related party disclosures provide transparency on management's transactions and relationships that might influence decision making. That is a point. Reduction in warranty. What will be your treatment of the management's refusal to review the provision from 5% to 10%? So, because we had said that the auditor should request the management to review the provision warranty to bring it back from 5% to 10%, but the management has refused to do so. What are you required to do? Third scenario. So says adverse. So are you guessing? Because it is qualified, so you guess to just be adverse, so that it doesn't appear like all of them will be qualified, except for. And always remember, candidates, and I emphasize in our last lesson, and I continue to emphasize, you will have a question on if you are going to sit for the exam on types of audit opinion. An adverse opinion is only issued where a misstatement or an omission is not only material but also pervasive. So before you say adverse, you need to establish if this misstatement is pervasive, meaning widespread. Is it widespread? Or is it affecting only the warranty provision? Let that be your guide. Okay? So if management does not adjust the warranty provision, the auditor should consider a qualified opinion except for, because the warranty may be materially understated. So the reduction in provision is not supported by evidence of decreased warranty claims. It's not supported. In fact, we are told that the warranty claims have remained the same for the last 2 years. So by reducing the warranty, yet the actual claims have not reduced, raises concerns about the accuracy of the reported liabilities and could mislead the users regarding the potential future cash flows and even related customer claims. So again, here issue except for, issue except for qualified opinion.